Hello everyone. Today we're going to discuss financial management. This video is designed to help students as well as non-finance background individuals to understand financial management, how finance is applied and how it helps in transforming a business. Before we begin, we need to understand first what is finance. Finance is an economic and monetary resource which is regarded as the backbone of any economic activity. Any transactions related to economic activity involves finance. It acts as a medium of exchange and has all the characteristics of money. We can also say that money is equal to finance. It is also involved in the science and art of managing financial resources in order to earn more revenue. The dictionary definition of finance states that finance is the system that includes the circulation of money, granting of credit, the making of investments, and provision of banking facilities. This captures the whole broad area of finance. Thus, finance is subdivided in three parts. Number 1, financial management. Number 2, capital market. And number 3, investments. Here in this video, we are going to discuss financial management. It is also referred to as corporate finance, where it focuses on decisions such as how much or what type of assets are required, how to raise capital in order to purchase assets, and how to run a firm in order to maximize its value. In the beginning, a corporation decides, number 1, what kind of business is suitable. Number 2, what types of assets and how much of asset is required, such as land, building, machine, raw materials, etc. Once the estimation is done in monetary terms, the decision follows to the next stage where it is decided how this money can be financed or raised, whether in terms of equity or in terms of debt. So here equity refers to the owner's own money or shares, and debt refers to either bank loan or debentures. Now when money is provided by the investors, there is an expectation of a return or interest depending on the type of the funding, whether it's an equity, share or debt. The distribution of profit affects the share price of the company. This refers to the dividend policy. Hence, financial management is nothing but a management area which helps in rationally managing the financial resources for the economic benefit of the firm. We will try to understand this with the help of an example. Let's assume that Paul wants to start a book publishing business. We'll look into this from a financial management perspective. In order to begin, Paul will first decide on the requirements of his business. He would need a building, some computers and DTP operators, paper as raw materials, equipments, transportation, office space, and etc. These requirements are clustered in terms of long-term requirements, which are 5 to 10 years, and short-term requirements which are less than 5 years. The long-term requirements are those for purchasing assets such as plants, machineries, lands, etc., as they have a long life. And on the other hand, raw materials such as paper pulp, ink, power, rent has a short life. This requirement is also known as working capital requirement. Here, let's assume that all these requirements sum up to rupees 50 lakhs, where 30 lakhs is for long term and 20 lakhs is for short term. Number 2, the next process refers to the raising up of rupees 50 lakhs. That is, from where Paul will raise the money. He would have 3 situations. Situation A, self-financing. Situation B, through others in the form of equity, ownership shares. Situation C, part equity and part debt in the form of debentures and loans. Let's discuss the situations individually. Situation A. In this situation, Paul can finance his business requirement of rupees 50 lakhs from his pocket. But the problem that arises here is that he will have to pay a large amount of money as tax, as he will be the sole investor in the company. Moreover, his personal and domestic life will be having more stakes in the business, and it will be affected. He will, of course, enjoy sole decision making of the company, but in the long run, it will lead to a burnout and limit the growth of the company. Further, he will also bear the entire risk of the business. Coming to situation B, financing through others in the form of equity or ownership shares. Here, Paul goes up to his friends and known associates if they would be interested in investing money in his company. The ownership is distributed in terms of units known as shares. Each share represents a share price, and the sum total of this gives the value of the company. We will discuss shares in a different video. Usually, shares are issued in the capital market through stock exchanges and in the form of IPO, which is initial public offering. The friends and the known associates are interested on getting returns from their investments. Hence, they would be highly interested in investing in Paul's business. Here, the business risk and the tax will also be distributed among the equity holders depending on their participation in the investments. By this way, it will be easier and less stressful for Paul. The other equity shareholders have voting rights as well. Usually, corporations are started this way. Now, situation number C, part equity and part debt. In this situation, Paul decides to raise money from external source in the form of debt, either through bank loan or in the form of debt instrument. Since bank charge high interest, it will be ideal for Paul to go for debentures. Further, the interest paid on debt is tax rebatable. This is advantageous for Paul as he will be having more profit, as well as he will not share his ownership with anyone else. The situation is more suitable for an established corporation. Their assets become securities for the debt to be raised and backs up the credit. While raising the money, Paul also matches the period for which he requires the money, which affects the interest rate. Usually when the risk is high or the period is longer, the interest rate is higher. For example, Paul finances his 30 lakhs by taking a loan for a period of 5 to 10 years on the basis of the life of the asset, which might be 5 to 10 years. So long-term debt equals to long-term finance for Paul in terms of deciding the tenure of the finance. Now coming to the main third process, which determines which kind of assets are to be purchased by Paul. Here one should remember that it should not be confused with how or what assets. Here which kind of assets is focused more. Hence various alternatives are to be compared. For example, suppose Paul has 3 alternatives: machine A, machine B and machine C. In this case, preference will be given to that machine which has minimal cost and maximum benefit. Out of these 3 machines, machine B, for example, is selected. Why? Because it has low acquisition and maintenance cost along with higher return. This process is also known as capital budgeting. Now coming to the main fourth point, which is known as dividend policy. This refers to the distribution of profits among the shareholders or retention of profits or both. A 100% dividend will have a positive effect on the company. However, depending on the future scope, the company will decide whether to retain 100% profit or to retain 50% of the profit. Thus, we can conclude that financial management is basically related to 4 functions. The first function is fund requirement, followed by the financing decision, then the investment decision, and the last one being the dividend decision. So in the first decision, we decide what is the amount that we require for starting our business. In the second one, we decide from where we are going to receive the amount or raise the amount. And in the third decision, we decide which kind of assets, depending on our objective, what kind of assets we are going to select among various alternatives. And the final one being the dividend decision, which refers to the payment or distribution of profit to the investors. One should always remember that all these decisions go hand in hand. An efficient manager highly optimizes this for the betterment of the company and try to be more efficient in aligning all these four functions towards a singular objective, that is maximizing the value of the company in the long run. I hope this video was helpful for you. Please leave your comments, feedbacks, and until we meet next time, good day to all. Thank you.